Welcome back to the Daily Crypto Deep Dive. Bitcoin is falling again. Ethereum is under pressure. Altcoins are bleeding harder. And the question most people are asking today is simple. Why is crypto crashing when, just a few sessions ago, the market looked like it might be setting up for another move higher? And the answer is not just one thing. This is not simply, Bitcoin is down because of Iran. It is not simply Bitcoin is down because whales are selling. And it is not simply Bitcoin is down because people are panicking. What we are seeing today is a collision of several pressures hitting the market at the same time. Institutional outflows, a massive BlackRock IBIT dark pool trade, renewed geopolitical stress around Iran, oil prices rising again, bond yields becoming a problem, and Bitcoin failing to hold the technical levels traders wanted to see defended. So today, we need to break this down properly, because if you only look at the chart, it looks scary. But if you understand why the move is happening, it becomes much easier to separate real danger from short-term fear. Just before we continue, this episode is brought to you by Kraken, our official exchange partner. If you want a straightforward place to buy, sell, and explore crypto, Kraken is well worth a look. There is a link in the description, and when you use our Kraken link, you also help support the show. This is not financial advice, and crypto trading involves risk. But if you are serious about crypto, Kraken is one of the platforms to have on your radar. Now let's start with the biggest point. Bitcoin is not just falling because retail traders are scared. The real pressure today is coming from the institutional side of the market. That matters because for most of this cycle, Bitcoin ETFs have been one of the biggest support engines behind the price. When US spot Bitcoin ETFs are taking in money, Bitcoin gets a powerful flow of demand. Every day those products see inflows. Issuers need Bitcoin exposure, and that can help absorb selling pressure from miners, traders, and long-term holders. But when those ETF flows reverse, that support engine starts working the other way. And that is exactly what the market is worried about now. Reports say crypto ETF outflows have topped more than $2.5 billion over the last 2 weeks. That is not small. That is not random retail noise. That is real capital leaving the space, or at least stepping back temporarily. And when ETF demand cools at the same time Bitcoin is already struggling technically, it creates a very different market environment. Then came the story that really grabbed attention. Someone dumped around $1.29 billion of BlackRock's IBIT Bitcoin ETF in a dark pool trade. Now we need to say this carefully. This does not mean BlackRock itself dumped Bitcoin. That is not the right framing. What CoinDesk reported is that an unknown investor executed a massive block sale of BlackRock's IBIT ETF through a dark pool. A dark pool is a private trading venue where very large trades can happen away from the public order book. Institutions use them because if they tried to place a billion-dollar trade directly on a visible exchange, the market would probably react before the trade was completed. But even though dark pools are designed to reduce market disruption, the signal still matters. When a single investor sells more than $1 billion of IBIT, traders notice. It tells the market that someone very large wanted to reduce exposure, rebalance risk, or get out of a position. And that came at exactly the wrong time, because Bitcoin was already struggling to hold momentum. This is why the market reaction has felt heavier than a normal red day. It is not just that price is down. It is the combination of price weakness and institutional selling pressure. Investors are asking, was this one big isolated trade, or is it part of a broader shift away from Bitcoin ETF exposure? That is the first reason Bitcoin is crashing today. The ETF demand that helped carry the market higher is now looking weaker. The second reason is the macro backdrop. Earlier, markets had been trying to rally on hopes of progress around Iran. The logic was simple. If tensions cool down, oil prices could fall, inflation pressure could ease, bond yields could calm down, and risk assets could catch a bid. That kind of setup normally helps Bitcoin. But then the picture changed again. Reuters and the Wall Street Journal reported fresh tension in the Gulf region, with oil rebounding and global markets pulling back. That matters massively for crypto because Bitcoin does not trade in a vacuum. When oil spikes, investors worry about inflation. When inflation fears rise, traders worry the Federal Reserve may not be able to cut rates as quickly. When rate cut hopes fade, liquidity expectations weaken. And Bitcoin is one of the most liquidity-sensitive assets in the world. That is why oil matters to Bitcoin. Not because Bitcoin uses oil, not because Bitcoin is directly tied to Iran, but because oil affects inflation. Inflation affects interest rates affect liquidity, and liquidity affects how much risk investors are willing to take. This is also why stocks and Bitcoin can sometimes diverge. Earlier in the week, parts of the stock market were holding up better because U.S. equities still had support from earnings, technology momentum, and the there is no alternative trade. Some analysts have argued that U.S. stocks remain supported because investors still see them as the cleanest place to hide within risk assets. Bitcoin, by contrast, is more volatile, more sentiment-driven, and more exposed to fast-moving liquidity swings. So when the macro picture becomes uncertain, Bitcoin can sell off faster than the stock market. And when ETF flows are negative at the same time, that sell-off becomes more aggressive. The third reason is technical. Bitcoin had been trying to hold the $75,000 region as an important support area. That zone mattered because it was not just a random number. It was a psychological level, a recent support region, and a place where traders expected buyers to defend the trend. But once Bitcoin started slipping below that area, the market became more nervous. Technical traders look at this kind of move and ask whether Bitcoin is making lower highs, whether support is being tested too many times, and whether a breakdown could open the door to the next downside zone. The simple version is this. Around $75,000, bulls needed to show strength. They needed a strong bounce, rising volume, and signs that ETF selling was being absorbed. Instead, Bitcoin looked heavy. And when an asset keeps testing support without a strong reaction, traders start to worry that support is weakening. That does not mean Bitcoin has entered a long-term bear market, but it does mean the short-term structure has become more fragile. If Bitcoin can reclaim the $75,000 to $76,000 zone quickly, then this could still be viewed as a shakeout. If it fails to reclaim that level and starts accepting price below it, traders may start watching the lower 70,000 region next. And if fear accelerates, people will naturally begin talking about whether Bitcoin could revisit areas closer to $70,000. Again, that is not a prediction. It is just how traders map risk. Support breaks, then the market looks for the next area where buyers may step in. The fourth reason altcoins are getting hit harder is because they sit further out on the risk curve. When Bitcoin gets shaky, capital usually moves defensively. Traders sell smaller coins first. Leveraged positions get wiped out. Liquidity dries up. And coins like Ethereum, Solana, XRP, Dogecoin, Cardano, and the wider altcoin market can fall harder because they do not have the same level of institutional support as Bitcoin. This is a brutal but normal part of crypto cycles. Bitcoin falls 3 or 4%, and some altcoins fall 8, 10, or 15%. That does not always mean the projects have suddenly become worthless. It means traders are reducing risk. And in crypto, when risk gets reduced, altcoins usually take the biggest hit. That is why today feels worse for people holding a wider portfolio. If you only follow Bitcoin, the move is uncomfortable. If you hold altcoins, it can feel like the whole market is falling apart. But here is where we need to stay balanced. There are two ways to read today's crash. The emotional read is, institutions are leaving. Bitcoin lost support. Geopolitical risk is back, and the market is finished. The professional read is, the market is going through a forced reset after a period of weak momentum. ETF flows have turned negative. Macro risk has returned, and traders are testing whether Bitcoin can find a new base. Those are very different interpretations. Analysts who focus on flows would say the ETF data is the key thing to watch now. If outflows keep accelerating, Bitcoin may struggle to recover quickly. But if outflows slow down, or if we start seeing renewed inflows after this flush, the tone could change fast. The ETF market works both ways. It can pressure Bitcoin on the way down, but it can also help stabilize Bitcoin when demand returns. Macro analysts would say oil and yields are the bigger issue. If Iran tensions keep pushing oil higher, inflation fears could pressure risk assets. But if tensions cool again and oil pulls back, that could remove one of the biggest short-term headwinds. Technical analysts would say the chart is damaged, but not necessarily destroyed. Bitcoin needs to reclaim broken support, rebuild confidence, and stop making lower highs. The level around $75,000 now becomes important again. If Bitcoin gets back above it and holds, the breakdown may start to look like a failed move. If it cannot, then the market probably needs more time. And that brings us to the hopeful part, because there is still a constructive way to look at this. First, Bitcoin is not crashing because the network failed. It is not crashing because adoption disappeared. It is not crashing because ETFs no longer matter. It is falling because markets are repricing risk during a period of institutional outflows and geopolitical uncertainty. That is painful, but it is not the same as a broken thesis. Second, the fact that billion-dollar ETF trades are now moving through the market shows how institutional Bitcoin has become. That can create volatility, but it also shows Bitcoin is now part of serious capital markets. This is no longer a tiny retail-only asset being moved by a few forum posts. It is an asset being traded by institutions, funds, and large allocators. Third, these resets are often where the strongest future rallies are built. Not always immediately, not always cleanly, but markets need to wash out leverage. They need to punish overconfidence. They need to reset funding, sentiment, and positioning. The uncomfortable days are often the days that create the next opportunity. So for listeners, the message today is not to ignore the risk. The risk is real. ETF outflows matter. The IBIT dark pool sale matters. Iran and oil matter. Losing support matters. But panic is not a strategy. The better approach is to watch the evidence. Watch whether Bitcoin can reclaim $75,000. Watch whether ETF outflows slow down. Watch whether oil keeps rising or starts cooling. Watch whether altcoins stabilize. And watch whether the market starts absorbing bad news without making new lows. If that happens, this could turn from a scary breakdown into a reset. If it does not, then we may need to accept more downside before the next recovery begins. But either way, the long-term story is not over. Bitcoin has survived worse. Crypto has survived worse. And every serious cycle has moments where the market makes people question everything right before the strongest hands begin positioning again. So yes, Bitcoin is under pressure today. Yes, the market is fragile. But this is exactly when discipline matters most. Do not let fear make every decision for you. Follow the flows, follow the levels, follow the macro signals, and remember, volatility is the price of being early in one of the most important financial markets of our lifetime. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.